Welcome to the deep dive. Today we're tackling a really big question, one we all think about. How do you actually make your money work for you? Not just, sit in an account somewhere.
Right, we're talking about investing.
Exactly, investing, but not in that scary, complicated way. We want to show it as a smart, accessible tool, something anyone can use to grow their savings over time.
It's really about building towards those future goals.
Yeah, think about it. That dream house, maybe a comfortable retirement, or just feeling secure financially. These things don't just happen, right?
No, you need to actively work towards them, like planting something and nurturing it.
That's a good way to put it. And our goal today is pretty simple. Break down the basics. Explain the main options, stocks, bonds, ETFs, mutual funds, without the confusing jargon.
So you can make informed choices. Choices that are right for you.
Okay, but let's address the elephant in the room first.
Yeah.
Why invest at all? Isn't money safer just sitting in a savings account?
That's the common thinking, but it misses a key threat. Inflation. That silent thief that just eats away at the value, the buying power of your money over time.
So even if the number in your account stays the same, it buys less.
Precisely. Look at the last decade. Interest rates on savings accounts,
Yeah.
usually pretty low. Inflation, often higher. So your money's actually shrinking in real terms.
Ouch. Okay, so savings accounts aren't really keeping up. How does investing fight that?
Well, investing puts your money into things like businesses and projects, things that have the potential to grow. It aims to grow faster than inflation.
Keeping ahead of rising prices.
Exactly. And that leads to maybe the most powerful concept in investing. Compounding.
Ah, yes, compounding.
The snowball effect.
That's it. It's where your returns start generating their own returns. It sounds simple, but over time,
Wow, it makes a huge difference.
a massive difference. That's why starting early is so crucial. Even small amounts invested regularly can become really substantial given enough time. Time is your best friend here. Plant those seeds early, let them grow. Okay, so the why is clear fight inflation, harness compounding. But the how, that's where people get stuck. So many options.
It can seem overwhelming.
Let's break it down. Starting with the most famous one, stocks, also called shares or equities. What are we actually buying?
Okay, so buying a stock fundamentally means you're buying a tiny piece of ownership in a company. Think of, say, your favorite coffee shop chain. Buying their stock means you own a little slice of that business.
Okay, I own a tiny part. What does that get me?
Two main things, potentially. First, if the company does well and its value increases, the price of your stock can go up. That's capital appreciation.
Right, the stock price goes up.
Second, some companies share a portion of their profits with shareholders. These are called dividends. So you might get regular payments just for owning the stock.
So potential for growth and income. Sounds good. What's the catch?
The catch is risk. If the company struggles or the overall economy hits a rough patch, the stock's value can fall. You could lose money.
Ah, so it's not guaranteed.
Definitely not. Stocks are often described as a bit of a roller coaster. Exciting, yes. Potential for high growth, absolutely. But they can be volatile, especially in the short term. Lots of ups and downs.
So probably best for people investing for the long haul, people who can handle seeing their investment value dip sometimes without panicking.
Exactly. Long-term investors who can ride out those bumps. And a key strategy always is diversification.
Don't put all your eggs in one basket.
You got it. Spreading your money across different stocks, different industries, maybe even different countries. It reduces the risk if one particular company hits trouble.
Makes sense. So stocks, high growth potential, direct stake in the economy, but definitely comes with risk and volatility. Needs patience.
Well put.
Okay, moving on. If stocks are the roller coaster, what about bonds? They sound calmer.
They generally are. Think of buying a bond as lending money. You're loaning your cash to a company or maybe a government.
It's like an IOU.
Essentially, yes. In return for your loan, they promise to pay you back the original amount at a future date, and along the way, they pay you regular interest payments.
Okay, so it's more predictable income.
That's the main appeal. Bonds are usually more stable than stocks, less dramatic price swings, more steady income. Now, there are different types.
Like government versus company bonds.
Right. Government bonds, especially from stable countries, are generally seen as very safe. Company bonds or corporate bonds depend on the financial health of the company, so they carry a bit more risk, but usually offer slightly higher interest.
So there's still some risk, but generally less than stocks. What's the trade-off then?
The main trade-off is usually lower returns over the long run compared to stocks. You're trading that high growth potential for more stability and predictability.
Okay, So why hold bonds then, especially if you have a long time horizon?
Great question. They play a vital role in balancing a portfolio. They act as a cushion when the stock market gets bumpy. That stability can be really important, especially as you get closer to needing the money, like for retirement.
So they help smooth out the ride.
Exactly. You probably won't get rich quick with bonds, but they can help you sleep better at night. Think of them as the reliable anchor in your investment mix.
Anchor, I like that. Okay, so stocks and bonds require some individual picking, some research. What about ways to invest that are more bundled? Let's talk ETFs, exchange traded funds. Sounds technical.
It sounds more technical than it is, really.
Yeah.
Think of it like buying a pre-packed shopping basket instead of picking every single item yourself off the shelves.
A basket of investment.
Precisely.
Right?
An ETF holds a collection, a basket of assets. Could be stocks, could be bonds, could be a mix. And the cool part is you buy and sell the whole basket with just one click, just like a single stock on an exchange.
So instant diversification.
That's the huge advantage. For example, you could buy one ETF that tracks, say, the FTSE 100 index. Instantly, you own a tiny slice of the 100 largest companies in the UK.
Wow. Okay, so if one company in that basket has a bad year,
The others can help offset it. The diversification is built in, and another big plus. Low costs. Many ETFs are passive. They aren't trying to beat the market. They just aim to match a market index like the FTSE 100 or the S&P 500.
no expensive manager actively picking stocks.
Right. That keeps the fees really low compared to many other types of funds. They're easy to buy and sell. They're cheap. They're diversified. Honestly, they're often perfect for beginners.
Simple, low cost, and spreads the risk. Sounds pretty appealing.
Very much so.
Okay, so ETFs are like a pre-packed basket, often passively tracking a market. What about mutual funds? They're also baskets, right? But different.
They're also baskets, yes, but the approach is usually quite different. Think of a mutual fund as hiring a professional shopper for your investments.
Okay, a pro doing the picking.
Exactly.
Hmm.
You pool your money with other investors, and a professional fund manager actively researches and selects investments, stocks, bonds, whatever fits the fund strategy.
And their goal is?
Their goal is usually to beat the market or a specific benchmark using their expertise in research. It's called active management.
So it's a hands-off approach for the investor, if you want someone else making the day-to-day decisions.
Totally hands-off. You're trusting the manager's skill, and there are thousands of mutual funds out there catering to all sorts of different goals and risk levels.
Sounds convenient. What's the downside?
The main downside is cost. Because you're paying for that active management, that expertise, the fees are typically higher than for passive ETFs.
And is there a guarantee they'll actually beat the market?
No guarantee at all.
Yeah.
That's the big debate. A lot of research shows that after fees, many active managers actually struggle to consistently outperform their benchmark index over the long term. Some do, of course, but it's not a given.
So you pay more, but might not get better results than a cheaper passive ETF.
It's a real possibility you need to consider. Still, for people who want that professional oversight, who trust a specific manager or strategy, and don't mind the higher fees, mutual funds are a very solid, well-established option. Investing made easy, with a pro potentially in your corner.
Okay, that's a clear distinction.
Yeah.
So let's quickly recap the four. Stocks, high growth potential, high risk, you pick them. Bonds, lower risk, lower return, steady income. ETFs, baskets, usually low cost. Instant diversification, often passive. Mutual funds baskets, higher cost. Active manager trying to beat the market.
That's a good summary. And thinking about effort, stocks and bonds often need more homework from you. ETFs and mutual funds are generally lower effort.
Costs. ETFs and stocks usually cheapest. Mutual funds cost more.
Right. And control. Stocks give you total control. Funds mean you're letting an index or a manager handle things.
For someone just starting out, it feels like ETFs or maybe mutual funds offer a smoother entry point. Less chance of making big mistakes early on.
I generally agree that built-in diversification really helps manage risk and can prevent those emotional decisions, like selling low during a dip, which beginners are sometimes prone to.
So it really boils down to balancing control, cost, and your own comfort level. Like, do you want to be the pilot steering everything, or are you happier as a passenger trusting the route?
Exactly. There's no single right answer.
Maybe an analogy would help here. Let's try the gardening one. Imagine 4 friends, Amy, Ben, Chloe, and David, all starting a garden.
Okay, I'm listening.
Amy's adventurous. She plants one single, super rare, exotic orchid. High risk, right, but potentially a stunning reward. That's like buying a single speculative stock.
Could be amazing, could completely fail.
Got it. Ben is practical. He plants potatoes. Reliable, steady growers, consistent yield. Not glamorous, but dependable. That's like bonds.
Steady eddies, predictable results. Makes sense.
Chloe wants variety but doesn't have much time. She buys one of those pre-seeded salad trays from the garden center. A mix of lettuce, herbs, radishes maybe. Easy, diversified. That's the
And
ETF.
pre-packed basket, little effort, lots of variety. Nice.
And David, he wants the best garden on the street but knows nothing about plants. So he hires a professional landscape gardener, pays them a good fee, trusts their expertise to deliver amazing results. That's the mutual fund.
Paying for the pro, hoping for that market-beating performance. Got it.
So the lesson is,
Each approach works for different people.
yeah,
Amy's taking a big swing. Ben wants reliability. Chloe values ease and diversity. David wants expert help and is willing to pay.
exactly. It's all about matching the strategy to your personality, your goals, how long you plan to invest for, and yeah, how much risk you're truly okay with.
That's the core message. The best investment isn't universal, it's personal.
So if you're listening, start by asking yourself some honest questions. What am I actually saving for? A house down payment in 5 years? Retirement in 30?
How long do I have? That's crucial. And the big one, how would I feel, how would I react if my investments suddenly dropped 10%, 20% in value?
Be honest with yourself about that risk tolerance.
Absolutely paramount. If simplicity and broad diversification sound good, maybe start looking at a low-cost, broad market ETF or a well-diversified mutual fund. It's a great starting point for many.
And maybe the most practical advice is just start. Set up a regular monthly contribution, even if it's small to begin with. 20 pounds, 50 pounds, whatever you can manage consistently.
Yes, consistency is king. That regular investing, dollar cost averaging, combined with compounding over time, it's incredibly powerful. Don't try to wait for the perfect time to jump in.
Because nobody can reliably predict the market's short-term moves.
Exactly. Study after study shows time in the market beats timing the market almost every time. Our emotions often lead us wrong when we try to be too clever.
So the final thought really is about patience and consistency. Compounding needs time to work its magic. Taking these first steps, however small.
You're giving your future self a really valuable gift. You really are.
You've got this. Start exploring, start learning, and take that first step.